The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and thank you for joining us for today's free webinar, Accounting for Tech Startups, Simplifying and Getting It Right with Cirque Rowe from Early Growth Financial Services. I'm Gina Longmire, and a marketing manager for Early Growth Financial Services, and I'll be the moderator for this webinar. The presentation will run about 40 minutes. We'll have time for question and answers at the end. However, if you have questions as we go through the presentation, please feel free to enter them in the question field. We'll answer them as they come in if we can, or if not, we'll wait until the end of the presentation to address them. If we run out of time, we will follow up with an email after the presentation to make sure that all of your questions have been answered. If you have follow-up questions, you can always tweet them to @earlygrowthfs with the hashtag #StartupAccounting. In addition, you'll be receiving an email tomorrow with the link to the slide deck and recording. I want to start today by introducing our presenter, Mr. Cirque Rowe. Cirque is the Chief Operating Officer for Early Growth Financial Services. Cirque has 25 years plus experience with finance and 17 years serving in financial leadership roles with the high-tech companies. He's an accomplished finance executive focused on leading early-stage companies through strategic financial decisions. Before we dig into the agenda, I was hoping Cirque could say a few words about Early Growth Financial Services. Cirque?
Thank you very much, Gina, and hello, everyone. Thank you for taking time out of your short holiday weekend to spend a little bit of time with us. Sure, a little bit about Early Growth Financial Services. We are an outsourced financial and accounting services firm. We are a national firm with offices started here in the Bay Area. We also have offices in Los Angeles, Las Vegas, Seattle, Washington, Boulder, Colorado, Austin, Texas, Chicago, Illinois, and New York. And we have a little over 400 active clients we work with. The classic sweet spot for us are companies that have raised a seed or Series A round of financing. That's usually when we start working with them. And basically, we provide accounting services on an hourly basis as opposed to any kind of a monthly minimum or retainer fee basis. And so for companies that need assistance with their accounting and financial guidance, but who don't want to be hiring people internally and who don't want to be spending the money and you want to bring in experts on day one, then we're a good company to speak with. We basically have four types of services. We do corporate tax returns. We also do 409A company valuations for companies providing stock options to their employees. We do transactional accounting and bookkeeping. So that's the day-to-day, week-to-week, and month-to-month accounting. And that includes a hard monthly close of the financial books and creation of financial statements that you could give out not only to your management team and to yourselves, but also to any investors and or lenders that might want those financial reports as well. And finally, we provide CFO level services. So in addition to review of your monthly financials, the CFO would be able to provide you guidance with things like putting together budgets and putting together cash flow statements and financial plans, long-term plans, maybe assisting with fundraising, help with board presentations and board packages, and any other higher level guidance that you would want, but on an hourly basis as opposed to paying for someone full-time.
Great, thank you so much, Cirque. And with that being said, let's jump right in.
Fantastic. So we are talking today about accounting and how to set things up and what you need to be thinking about. And actually, I'll even go so far as to say, even before we start thinking about, the accounting piece of it, I'll say the two things that you as entrepreneurs and starting up a tech company, the two things that you really need to be thinking about are product development and customer acquisitions. And that's where your primary focus should be, on those two things and those two things only. Anything that is taking efforts and bandwidth away from those activities, I would say is time and resources not being spent wisely. And so, minimize the distractions, minimize the things you have to do, keep it as simple as possible for everything else, and focus your energies on those two things: product development and completion, and then figuring out a strategy and then implementing a strategy and executing on the strategy of acquiring customers. And so, when it comes to accounting, I'll say that initially early on, it shouldn't be a primary focus, and it shouldn't be anything that you spend a lot of time on. Just think about making sure that you allow yourself the opportunity for growth, for expansion. You need to be flexible enough to, for as the company grows, that you're able to make decisions, and the accounting and financial information that you're getting is going to help you to do that. And so, initially, what are you thinking about? These are the things you're thinking about. Just basically, where's the money coming in, and where's the money going out, and where can I best be using those resources, and how do I maximize the money coming in? How do I maximize or optimize the timing of that money coming in? On the cost side, obviously, how do I do as much as I can for as little as possible? How do I push out the cash out, or the expenditures? How do I push that out as far as possible? Can I do things like leverage vendor terms to push off payables? Can I use credit cards? How about just doing more with less? How about bartering services? Basically anything that you can be doing to try to minimize the cash out. And so when you take those two things in, the cash in and cash out, obviously that gets you to your cash burn. And that's probably one of the key things that you need to understand, and you need to be focused on a regular basis. You always need to know what your cash burn is. You always need to know when your runway runs out, right? When your time to live runs out, so that you know what you have to accomplish, and if you need to fundraise, you need to fundraise. If you need to increase revenues or cut off expenses before you run out of money, you need to do those things. But understanding your cash burn and the time to live is really critical. The short term and long-term financial goals, obviously, these need to be, I'd say they're secondary. I'd say they're secondary to your other goals, your other corporate goals, and the milestones that you're trying to achieve. If you're like most tech startups, basically the way that the financing of your company is going to go like this. You may get a little bit of money coming in from revenue. Yes, we want to see that, and investors are going to want to see that. But in most cases, if you've got the kind of business model that is fundable by outside investors, then what you're going to be doing is you're going to be fundraising, and you're going to be getting investors to invest in your company, invest in your idea, invest in your team, and you're going to be hopefully growing your company. And as you grow, you're going to be able to raise more money to help you grow that company. And so, yes, there are short-term financial goals and long-term financial goals, but even more importantly than that, I would even go so far as to say it's those kind of the product development and customer acquisition milestones and goals that you should be establishing, because I think the financial goals are going to be a precipitate out of that. And if you're doing things right, if you're setting up the right milestones, and if you're achieving those milestones, then I think that you're going to be much more successful in your abilities to fundraise. And when you fundraise, then obviously the short-term financial goals are taken care of. So having said that, why do we need to worry about accounting? Basically accounting is kind of the framework and the foundation, right? That you need to understand kind of what's happening with your company, what's happening with your cash, what's happening with your burn. It'll give you very valuable insights into what's going on, especially when you're first getting started. It will tell you how much it costs, to hire people, and not just to hire people and the salaries, but the benefits and the fringe benefits that are associated with it, the overheads that are associated with it. It will show you. If you have revenue, if you're accounting for your revenue, and if you're accounting for your cost of goods correctly and properly, it'll show you what kind of gross margins you're having, and it'll give you valuable insights that will help you make good decisions about whether you need to be changing your pricing structure, or whether you need to be changing the way you go about acquiring customers. Maybe if you're doing it really well, you'll be able to tell what kind of returns you're getting from different things like your advertising campaigns and your email campaigns and direct mail campaigns, and all those things are going to help you manage your company much better. It'll also give you insights and hopefully a history to help you with your long-term planning. And the long-term planning is really what you're going to be using for not only planning for yourself and to make sure that you're hitting the milestones, but also the long-term planning is really what you're going to be using from a financial modeling perspective to help you go out there and raise money from investors. Investors need to know that you understand your business enough, and not just your product development, not just your product and technology, and not just your customer acquisition strategy, but also just your business well enough so that they feel confident that when you say you're going to hit these metrics and I need $1 million or $2 million from you, and that's going to allow me to do this, they need to feel confident that you understand your business enough to know that you're going to be able to achieve what you're saying. When they give you that money. And so you're not going to be able to raise money without a long-term plan and understanding your accounting and having it set up properly from day one, or sometime soon after you get started is going to help you. The saving you the money over the long term, I think that this kind of depends. I think there are some entrepreneurs who are actually really, really good at just kind of understanding at a high level, or almost at an intuitive level, kind of what's happening with their money, and kind of what's happening and where they should be spending their money. I think there are some entrepreneurs who are very, very good at that. I've seen them be very, very good at that without hard numbers, because they just have an intrinsic knowledge about it. But for most entrepreneurs, I say that that's not the case. I say that most entrepreneurs need to see the numbers, need to be shown what they are, need it to be explained to them, and then when they see the history and when they see kind of what they really are spending and not just how much cash is going out necessarily, that's really when that gives them the tools to actually start implementing strategies to save them money over time. And it's things like we point out things like, hey, listen, you might have hired an employee a little bit too early, or you're paying too much for rent based upon the number of employees you have, or it seems like hey, we just spent a lot of money on an email campaign and it wasn't really the time to do that, and next time can we do it, can we be a little bit smarter and spend less money. And those are the types of things that you can learn if you've set up your accounting properly and you're looking at the numbers that are coming out after proper accounting treatments. And finally, obviously, and I mentioned this already, but to the extent that you're going to be going out to investors or to bankers or to other lenders, they're absolutely going to require that your accounting is up to snuff. Okay, so these are some of the things that we're going to be talking about today. We're going to be talking about kind of what you need to be doing from an accounting perspective, both pre and post funding. And I think it's a little bit different. Yes, we'd love to do things as robustly and as completely as early as possible, but the practicality of the matter is that you're not going to have the wherewithal, you're not going to have the resources, and quite frankly, it's not going to be as important to you pre-funding to get things exactly correct and accurate. And so I wouldn't suggest you do that. So we're going to talk about kind of what you want to be doing initially versus as you get ready for financing or fundraising, and then after fundraising, because there are two different things. We'll talk about different accounting systems, not only from an accounting perspective, but also some of the administrative issues related to accounting and bookkeeping and accounts payable and accounts receivable and expense reimbursement management and things like that. We'll talk about some of the things that you can do to really, really set yourself up for success today as well as later. We'll talk about taxes, and this is one thing that even if you're a beginning startup, you need to be mindful of your tax obligations, your reporting obligations, as well as your payment obligations, and we'll talk about that. We'll talk about accounts payable and accounts receivable, and then finally we'll talk a little bit more about projections and what you need to be thinking about and how you need to think about putting together financial projections for yourself as well as for investors. And there's two really different ways of doing it, a tops down versus a bottoms up, and we'll talk about those things. Okay, so what do you need to be thinking about pre-funding and what do you need to set up? And this, I would say, okay, and when I say pre-funding, I'm talking about a company that has an idea. The founders have an idea. They're doing this on their own. Maybe they're still working with another company. Maybe they've decided to cut the ties and focus on this 100% of their time. They've probably put a little bit of money, their own money into it. They might have borrowed a little bit of money from friends and family to kind of get things started, but you actually don't have outside investors. And at this point in the stage, and you're just kind of ramping up, these are the things you just need to be focused on. The very, very ground thing is set up your company, so incorporate your company, and once you do, open up a business account, open up a business checking account, open up a business credit card, because what you need to do is you need to completely segregate your personal and your business expenses. And so, yes, you're going to be putting money in, and so it's still your money, regardless of whether you spend it personally or from the company, but make sure you have that segregation. So let's say you're putting in $10,000, or you're going to spend $10,000. Well, if you buy some office supplies or if you pay for some services, we don't want you to do that from your personal checking account or for your personal credit card. Instead, we want you to deposit that $10,000 in personally into your business checking account, and we want you to spend the money and cut the checks from that business checking account or from the business credit card account. And the reason for that, there's two reasons actually. One is just when we go back and we need to account for it, having all that stuff segregated and really knowing what the business expenses were versus personal expenses will help us, and it'll save us money in the long run later on when we go to recreate some of the transactions from earlier on, and so ease and cost perspective. But more importantly than that is the idea of legal protection. Right? So one of the reasons why you're setting up a corporation is to limit your liability. You want to limit the liability to the assets of the company. And so regardless of what your intentions are, if you're actually conducting business transactions from your personal checking account or from your personal credit card, then someone at some point who has a beef or a dispute with your company may ask for records, and someone may claim that, hey, look, you were actually doing business, you were commingling the activity personally versus the corporation. And so when we sue the company, we actually have a right to sue you as an individual as well. And so it's a tough hurdle to overcome from a legal argument perspective. But the point is, and in most cases, they're not going to win that argument. But the point is that there's just no reason why you want to subject yourself to even any of that kind of risk whatsoever. So it's simple to set up a business account. All the bank needs is an EIN or an employer identification number, which is what you're going to get from the IRS after you incorporate your company. And once you do that, then any bank will obviously open up an account for you and give you a credit card. So make sure you do that. Keeping records of your receipts and invoices, I think that's pretty obvious. It's getting a lot more easier now because everything is online, right? So we get emailed invoices, and we see all of our transactions on credit cards and things like that. But still, until they've actually been entered into an accounting system, you want to make sure that you keep track. You keep track of what was spent and what you've received. We'll talk again about being careful of tax considerations. As a corporation, you're going to be filing taxes regardless of whether you make money or not, whether you have income or not. You still need to file taxes. At an absolute minimum, federal taxes and at least one state, wherever you're doing business, you're going to have to file taxes. You may also have to file some tax returns from local organizations, and that's kind of on a local basis. But just do some research where your company is located, where you're doing business. Do some research. If you have any questions at all, if you have any uncertainty at all, please, please, please speak with a tax specialist, and not just a CPA who does personal taxes, but a corporate tax specialist. We've seen companies get into a lot of trouble, for not having filed just because they were unsure. And so you want to keep from doing that. And we'll talk a little bit more about that. Collecting payments. If you already have revenue, then make sure that you're collecting payments on a timely basis. Two reasons again for this. One is obviously from just a cash flow perspective. If somebody owes you money, you want to collect it as quickly as possible and get that cash in as quickly as possible. But in addition to that, there's tons of history that suggests that a longer a receivable is sitting on the books, the likelier that we actually won't be able to collect on it at all. And so we just don't want to let anything linger. If you have the kind of company or the business model that that people are paying for your service or your product online with a credit card, perfect. You don't have to worry about that stuff. But if you are having to invoice anyone, if you're having to go through some purchasing department, and their accounts payable department to make payment, then you need to stay on top of it. Select a payroll provider. There's many of them out there now. It used to be the days when you'd have to go with an ADP or an Intuit for your payroll. There's many more options now. There's a great SaaS, or a software as a service payroll service provider called Zen Payroll. They do great work, and the cost is minimal, and so you just want to set up something like that. And obviously, if you're giving out any stock options, or you have co-founders and there's stock that has been granted both to yourselves as well as to your co-founders and to any employees, stock options, obviously you need to stay on top of that. So, initially, when you're pre-funded, you just kind of want to keep it as simple as possible. We didn't talk yet about the accounting software, so let's talk a little bit about that. I think it doesn't make sense at this point to not do accounting software. I think you should be, there's several options now, and again, because software as a service is such a great tool in many ways, I think that even as an early stage company, you want to be using a tool like that. QuickBooks, which is kind of the most prevalent accounting software, has an online version, QuickBooks Online, that is hosted by Intuit, the parent company. I want to say it costs $25 or $30 a month to set up. Very easy chart of accounts that are already kind of standard templates for the kind of company you have. Kind of get things set up and start entering transactions. If it's even too early for that, then I'd say, okay, fine, just keep track of what you're spending, keep track of your bank accounts and the bank account statements, and at some point we'll go in and reconcile it when you do set it up. But again, just because of the low cost, I just think that it just makes sense, and you'll save money in the long run if you actually start entering transactions. If you have lots of accounts payable, if you're paying a lot of bills, if you're sending out invoices to customers and you want to keep track of that, use services like Bill.com. If you have employees who are submitting expense reports to you, then use tools like Concur or Expensify. And there's other tools out there too. But the point is that now there are just so many great tools that are available to you that are on a use basis, as opposed to having to buy a big expensive software. And so leverage that. Everything that we do is absolutely virtual, so it allows us to work from basically anywhere. We don't have to be at a client site, and just like that, you and your employees don't necessarily have to be tied to a desk either. So much can be done, including accounting, and including expense management, and including invoice management, being done online without any paper at all, hard paper at all. And so let's do that. Okay, accounting accounting post funding is a little bit different because now, and when we say post funding, we're talking about where you have institutional investors or you've gone out and fundraised and you've raised some money from either angel investors or from traditional VCs, and now you've got some money in the bank, and now things change a little bit. Things change because investors need to have a little bit more visibility. What you've been doing up until now may not be sufficient for their needs. And again, also you now need to start setting up the foundation, the infrastructure, so that you can grow the company. And so think about some of these bullet points on here as you go about setting up the infrastructure on the back end, and it's for things like the financial infrastructure. So use some of those tools. If you haven't set up QuickBooks Online or QuickBooks Enterprise software, if you haven't set up Bill.com, if you don't have expense management and people are sending you Excel spreadsheets to submit their expense reports, this is the time to do it. This is the time to set that stuff up because otherwise it's going to be a bigger and bigger and bigger headache as you grow the company, as you get more employees, as your transactions get more and more complicated. It's going to be harder to go back and try to backdate all that stuff. So do it now. Obviously managing your cash flow is going to be critical because the one thing that you're going to want to the one thing that the investors, well, no, let me take that back. Investors are going to be requiring a lot and demanding a lot from you, but absolutely one thing they're going to be demanding is to know what their money is being used for and how long it's going to last. So this what we call the runway or the months to live or time to live or any of those types of terms that we use, knowing that number or knowing that date is really, really critical. And so you need to be staying on top of it. You need to understand, what's happening from a financial perspective, what's your spending looking like, what's your revenue coming in looking like. All those things are going to be critical. If there's ever any changes to that date, if, for example, let's say, hey, look, you know what, you really needed to step up spending, or it ended up costing you more to hire key employees than you thought it was going to take, or all of a sudden, you had to you found a problem in your product development and you had to hire some consultants to come in and actually help fix the problem. All these things are going to have an impact, and you need to be aware of it. You need to be able to track it and figure out kind of what the impact is to you and to your company and to the cash, and you need to report that to your investors as quickly as possible. So it's one thing to go to an investor and say, hey, over the last week or 2 weeks, we've had to do this, we've spent a little bit of extra money, and this is what the impact is going to be to us, right? That's one message. The one thing that you can't do and that they are going to really, really come down on you hard for is if you go in a month or two after the fact and said, hey, remember 2 months ago, Mr. Investor, we told you that our cash was going to last us until June of 2016. Well, as it turns out, over the last couple of months, several things have happened and blah, 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 and now that cash is only going to last us until March of 2016. Trust me, that is a conversation that you do not want to have. So understanding your cash flow and managing it is really, really critical. Investors at this point now are also going to want to see clean financial statements. And when I say clean financial statements, I'm talking about GAAP, right? So this is on the last bullet point. So GAAP is an acronym for Generally Accepted Accounting Principles. And what GAAP does, it basically levels the playing field and reporting field so that when people see a set of financial statements that are GAAP compliant, then they can feel comfortable that that the company has followed similar types of rules that have been established across the spectrum of companies and accounting treatments, so that they can say, okay, look, when I compare this set of financials to another company's set of financials, I can actually do an apples to apples comparison. And so they have rules for matching up revenues and expenses, the timing of them. They have rules for accruing for things instead of just looking at cash treatments. They have rules for how you recognize revenue, and they have rules for how you treat, for example, assets like fixed assets and putting them on your balance sheet as opposed to expensing them when you first purchase it. And so, understanding the rules and following these rules and using those in your financial reporting is a must. It's demanded by your investors. Otherwise, again, they don't feel they can't have the confidence that the financial statements that they're receiving from you truly reflect the financial condition of your company at that point in time, and that's a big no-no. And so if you don't, at this point in time, I'd say if you don't have the wherewithal, or if you don't even want to deal with it, let's say you do have the wherewithal, but you don't want to be dealing with it because you need to be focused on other things, then this is probably the time to bring in professionals to help you to help you become GAAP compliant. Okay, just a little bit about accounts payable. I don't think there's much here. Again, if you have a company where you don't, where it's really early on, you might be spending a lot of your, like most of your spending might just be with a credit card that you pay once a month. Other than that, you're paying a couple of employees and you're paying rent and things like that. Then it's not that big of a deal. But at some point, you're going to grow. And if you I would even go so far as to say that you want to set up more accounts payable, because really what you're trying to do is, again, maximize your cash flow. And if you're buying enough things from vendors, if you're buying enough services, if you're buying enough consulting from people, whatever it is, then we should be trying to set up accounts payable. We don't want to be paying for things with cash. We want them to send us an invoice that says, hey, Mr. Customer, you purchased this, or this is the service that you signed up for. Yes, you can start using the service on day one. Here's your invoice, and you have 30 days to pay us. We want that, right? And so every time you can, you should try to set up accounts with vendors for a couple of different reasons. Again, one is cash management. We just talked about that. But the other thing is you want to start setting up your credit history. Right, so credit history for your company is very similar to credit history for yourself. I mean, we all know what credit scores mean to us. When it comes to trying to get a loan, right, or trying to apply for a mortgage on the house. Credit score is really important. Sometimes it keeps us from getting the loan that we want, and even if we are able to get the loan, a bad credit history means that we're going to be paying a higher interest rate. It's going to end up being more costly to us than if we had a good history score. So setting up accounts payable, making good on those payments over time will establish that credit history, just as taking out a loan on a car and paying that off establishes credit for yourself personally. You'll be able to do the same with companies. And so set it up. Have people send us invoices and then pay the invoices on time. Try to get as best terms as possible. If you can, ask for net 30, so that again, a vendor sends us an invoice and tells us that we have 30 days to pay that invoice. Try to set it up. You're not going to be successful all the time, especially early on when you don't have a history, but there will definitely be companies who are willing to work with you, and when they are, then do so. The next one is, and I'll kind of tie the two together with a system, but accounts receivable is the exact opposite, right? Accounts receivable is, you need to make sure that when you are giving terms to customers, you need to make sure that you're making it as easy as possible for them to pay you, and you're also making sure that you're staying on top of it. If you can get people to pay up front, again, do so. But in many cases, especially if you're selling to bigger companies, it's going to be impossible for people to pay on delivery or in advance, and so you are going to be setting up terms with them. So make sure that you're doing everything you can to make it simple and easy for your customer to pay you. And so it's things like creating friendly invoices. And whether you do it in Excel or Word, I don't recommend it. Again, if you're using something like QuickBooks, then QuickBooks has tons of templates that you can turn into your own. You could add logos to them. and you could have simple and automated invoices being generated that and get entered directly into QuickBooks. So there's absolutely no reason you should be doing it out of an accounting software. So but creator-friendly invoices, send them out. Do everything electronically if you can. You need to obviously stay on top of your open invoices. You need to do AR or accounts receivable aging reports to make sure that that accounts aren't falling behind. You need to, if they start falling behind, you need to start sending friendly reminders. I fully believe that in this case, many times the squeaky wheel gets the oil, and so squeak and ask for payment. It's your job. Part of your job is, or part of your company's responsibility is to make sure that you're getting paid for the product that you're delivering or the services that you're rendering. And so just make sure you stay on top of it. And whether that's you're hiring someone to do that for you, or if you even have to do it yourself, trust me when I tell you that getting cash in the door from customers is going to be a critical key success factor for you. So make sure that you don't shirk your responsibilities on that. For both accounts payable and accounts receivable, I think that a tool like Bill.com is an incredibly useful and very, very inexpensive tool. Again, it's a software as a service tool that basically allows you to set up rules and all invoices coming in, and overall, all bills coming in and invoices going out can be managed through Bill.com, so that it's really it really simplifies the administration part of it from your perspective. You just need to stay on top of it, but everything is done electronically. All the approvals are done electronically. You could set up the bank to Bill.com to actually work with the bank to make the payment on the due dates. It's very, very simple, and will make your life a whole lot easier, and the cost is really, really minimal. So look into tools like that. Taxes. Okay, let's get a little bit more into taxes. And the first thing, and I'll touch upon this a little bit, the legal entity of the company. And when I say the legal entity, we're talking about things like, whether you're a sole proprietor or a partnership, or whether you're a limited liability company, or whether you're an S corp or a C corp, a full corporation. And if these are new terms to you, or if you're not sure of what you are or why you chose it, I highly encourage you to do a little bit of research. You might have already worked with an attorney when you're setting up your company, or you will work with an attorney when you're setting it up. This is kind of the first consideration you have to undergo. If you're a tech startup, though, I'd say that in most cases, we're going to steer you towards a C corp, and that's kind of the full corporation status. And there's several reasons for that. The biggest one being that it allows you to give out stock. That stock is easy to transfer, it's easy to issue. You could have multiple classes of stock, which you're going to have if you have outside investors. You're going to be giving preferred stock to outside investors, and you're going to be keeping common stock for yourself and your founding team and your employees. So having multiple classes of stock, the ease of reporting, the cost of of filing taxes, all those are probably in your favor by setting up a C corp. The one reason why there's a disadvantage to C corps is it is double tax. So unlike a sole proprietorship or an S corp, which only taxes at the individual level, taxes for C corps are taxed twice. First, when the company makes money, reports earnings, and then again when they distribute those earnings to their owners. But keep in mind that if you're a tech startup, it's probably going to be a little while before you have any meaningful positive net income, and so that double taxation isn't going to be a factor for you for maybe quite a long time. And secondly, I think all the other benefits and also even just kind of the requirements from a stock distribution standpoint will basically point you towards the C corp. If you have any questions about that, I encourage you to do research online. There's tons of information online that'll educate you if you need to. Understanding your federal, state, and city tax regulations and obligations are really, really critical. I've seen companies, and don't make the mistake of saying, hey, you know what, I just started my company and all I have are expenses so far. I don't even have any net income, and so I know I just have losses. So let's not file. Same thing, with individual tax returns, right? You know that you can get yourself into a lot of trouble, even if you don't owe any taxes. You could get yourself into a lot of trouble for not filing, and that's absolutely the case with your company as well. And in some ways, it's relatively straightforward, but depending on things like where you do business. We talk about nexus in multiple states. Understanding that is important. If you have investors, and especially if you have international investors, it's really, really important, and it could cost you a lot of money if you don't do things, and if you don't do your filings correctly, by missing a couple of forms related to international investors. You could end up causing yourself tens of thousands of dollars of tax penalties. And so in the case of tax returns, hire a tax professional. If you have a simple company, the tax returns are not going to be expensive. You don't want to take on the risk of doing it incorrectly. So hire a tax professional. But first of all, understand what your obligations are, and make sure that you don't fall behind. The separate business and personal finances, that's from a different one, so I apologize. That really doesn't belong in there. The quarterly taxes. So if you are making money, I'm sorry, Gina, could you go back one slide? Thank you very much. So paying the quarterly taxes. So if you are making money, you need to report quarterly estimated tax payments. So again, do a little bit of research. If you're in this situation where you need to be reporting quarterly taxes, then please do so. Again, you can be hit with lots of penalties if you fail to do this. On the payroll taxes, so first of all, I'd say that you should not be doing payroll taxes. You should be, again, going back to a previous slide, you should be setting up a relationship with a payroll service provider. So whether it's someone online like Zen Payroll, or someone full service like ADP or whoever, but a professional payroll company should be doing your payroll. Do not try to do it yourself. And so if you're using a company like that, then they're going to be withholding taxes, payroll taxes, and they're going to be filing the payroll tax returns on your behalf. So you shouldn't have to worry about that. This only applies if you are trying to do it yourself, and if you are, then then first of all, I wish you the best of luck, as it's just a lot of work for not that much money. I don't know why anyone would be doing it. But secondly, just make sure that you're staying on top of it. 1099s. This is something that you do need to be aware of. So 1099s are forms that you have to give to certain individuals, and also file with the IRS. And who you're going to be giving this to are non-corporations with whom you do business, who you have paid a certain amount to in any given calendar year. And so the kind of the rules are that if you have a deal where you have paid more than $600 to any individual or any non-corporation, and this includes your landlord, and this includes your potentially, this includes your attorneys, this includes accountants, consultants that you're using, individual people that these are non-employees that are doing service for you, and you're paying them. You need to have 1099s prepared and sent by the 31st of every year for the previous calendar year, and then you need to report that same information to the IRS. And the reason why you have to do this is because this is the IRS's way of checking to make sure that people are they're individually filing their tax returns appropriately. And so this this is your way of reporting to the IRS. Hey, I paid a certain amount of money to these individuals, and then this also gives the individual notice that you have reported this to the IRS, and that they need to report, the earnings from your company as part of their earnings. And if you fail to do this and you get caught not doing this, you will be hit with, per instance penalties by the IRS. So again, you need to stay on top of it. We'll talk for a couple of minutes about financial projections, this is this is a question that comes up. This isn't necessarily accounting and setting up accounting, but this does go in line with, okay, your financial record keeping and keeping your financial house in order. And that's just making sure that, when you're doing financial projections, that you're doing it the right way. And there's two ways of doing it. You start with kind of a top-down projection to funnel down to what your potential revenue might be. And so we talk about, the TAM, or the total available market, which is the total market size. And then you identify a particular segment within that. And then you probably narrow it down to a smaller niche that, is serviceable by your company. And so you kind of come up with this potential revenue amount that you would be able to get if you own the entire market, which obviously you won't. And so from that, then you make some assumptions about what percentage of that market that you might be able to win, and from that you develop a revenue model that you can attain. Once you have that revenue model that you can obtain, and then ask yourself, can I really achieve those numbers, and make your tweaks. But once you have kind of that revenue model, then you need to kind of do a bottoms-up projection to really understand what the cost is going to be to achieve that revenue, and to capture that market share. And so think about all those things. Think about the people that you're going to need to hire and the timing of those hires. Think about the advertising dollars you're going to have to spend. Think about the development dollars you're going to have to spend. Are you going to do that internally? Are you going to hire external development firms? What kind of other resources do I have to hire? When do I need to start hiring some administrative folks? When should I start hiring a marketing person? What about the internal sales team? All those should kind of precipitate again from the revenue model and saying, hey, these are the milestones that I've set for myself. This is the revenue I'm trying to achieve, and in order to achieve that revenue, I know I'm going to have to hire these people. I know I'm going to have a certain amount of product development done by a certain date. I know I'm going to have spent some money on advertising. I know I'm going to have my website up and all those kinds of things, and do a bottoms-up report and analysis to get to that number. Financial reporting. So this is kind of to me, the absolute minimum. Again, once you have investors. Prior to having investors, I'd say, hey, if you've got an idea of how much you're spending, if you know how much cash you have in the bank, if you know that if you've got $60,000 in the bank and you're spending $8,000 a month, and that doesn't fluctuate too much, then there you go. That's all you need to know. But if you've got $500,000 in the bank or $1 million in the bank and you've raised money from outside, you need to do more. And at an absolute minimum, we're talking about these three classic financial statements, which is the profit and loss, or the income statement, the balance sheet, and then the cash flow statement. And if you're reporting those on kind of like a, I would say like a monthly trend basis, so that you're showing monthlies for whatever period of time, I usually like to go back 12 months. Then anyone looking at those financial statements should see the trend on where things are going. How has revenue increased over time? How has spending increased over time? What does the balance sheet look like over time? When have you fundraised? All those things should be readily apparent when you look at those two statements. The cash flow statement is just is almost like a byproduct of the profit and loss in the balance statement. I'm sorry, the balance sheet, but it'll just kind of give you a little bit of insights into, okay, well, here's my net income, but here are some of the other items that are not associated with my net income or the income statement that created differences in cash balance. And so looking at that quickly will give you an idea of where your non-income statement items of cash are going. In addition to that, I think once you get a little bit more complex, then I think you're going to want to do, a couple of different things. I think that, once you have enough history and once you want to have better reporting and better budgeting in place, you're going to want to set up a budget. And once you set up a budget, and that says that for the next 12 months, hey, this is where I'm going to spend, this is how much revenue I'm going to have. And so I'm going to be putting together a budget. And at the end of the 12-month period or 18-month period, this is where I expect to end up. But once you have that, and a lot of people I see them that they pat themselves on the back because they've put together a budget that has been approved by the company and has been approved by the board or their investors, and they say, great, I've done that. Phew, what a relief. We got a budget in place, and now I can just kind of go on my merry way and focus on my business. Well, the budget is the first piece of it. You need to actually, obviously, now you need to do what we call BVAs, or budget versus actuals. And this is where you have that kind of the line in the sand, the budget, and then on a monthly basis you look at your actuals and you compare those actuals against what you budgeted, and then you need to explain any significant deltas to it, whether it's on the revenue side or whether it's on the expense side or the hiring side or whatever it is. You need to be able to justify it to yourself. You need to be able to explain to yourself why there are differences, and for it to make sense. And if it doesn't make sense, then you need to be asking the question why, because I can guarantee you that the investors are going to be asking that question. And so you need to stay on top of it and have those answers, and hopefully be able to use this data to pivot and make changes in the future, as well as look at what happened in the past. And then there's other financial reporting too. I think things like waterfall charts for key performance metrics, things like cash and cash burn and revenue and headcount. I think doing waterfall charts is a tremendously effective way of communicating kind of what's happening over time. And if waterfall charts is something new to you, again, I encourage you to do a search on Google. You'll find kind of what I'm talking about, and you'll see what how it's used, how to set it up, and how it's used. But again, if it's something that you want to be doing, and if you think your company is going to benefit from doing it, then I would probably go so far as to say that you're far enough along where you should be having outside assistance or someone within the company who's already knowledgeable about this kind of stuff and who can do it for you. Okay, just when should you engage with a financial services support firm? And these are just some guidelines, and I think this is probably pretty accurate. But I'd actually go, I'd take a step back and I'd say, when you feel the pain, just like with anything else, I mean, you're gonna feel the pain. Trust me. You'll know when the time is right. You'll know when it's getting out of hand. You'll know when you start asking questions to yourself like, geez, you know what? I could have swore we should have exited October with $75,000 of cash, and instead we've only got $65,000 of cash. What happened? Or I don't know what my spending is going to look like 6 months from now. I have no idea. Once those kinds of questions start to creep into your mind and uncertainty starts to increase, that to me is a sign that you're experiencing the pain point and you need outside assistance to help you get your arms around it. And then finally, I'll just, this is kind of the final slide before we, open it up for a few questions. But these are just the things, just a check back against what you should be focusing on. Just keeping accurate, trying to keep as accurate of records as possible. Make sure that you don't fall behind on payments, whether they're tax obligations or payments that you owe to your partners and vendors and suppliers. Obviously, the tax obligations, and then the milestones, and I think that's probably the biggest one. We as a company, we focus primarily on milestones, whether they're financial, whether they're product development, whether they are customer acquisitions, whether they're fundraising, any of those things. We really have our clients focus on the milestones that they're setting, and the two questions we ask is, three questions we ask are, are those the appropriate milestones? are they achievable, and do we have the resources to achieve them? And those are the three questions that we ask of our clients whenever we talk to them about anything. And those are the questions that you should be asking yourselves as you think about not only setting up your accounting, but I think in everything that you're doing with your startup.
Okay, and as
So
we've
we've
oh,
kind of gone through. Yeah,
sorry, sir,
yeah.
go ahead. I was
Go
just
ahead,
going to
Gina.
say, as we've reached the end, I have a couple questions for you, but if you wanted to finish your thought, feel free.
Oh, no, that's what I was just going to say. If anyone has questions, I know there's a fair amount of information here, and I know that some of it is some of it it kind of makes a lot of people's eyes roll back when they think about the sheer difficulty and also the cost and the headaches associated with proper record keeping. But let me answer any questions that people might have.
Okay, we have one question that was asking when you were discussing buying goods on a customer's behalf. He gave an example that said, for example, we pay $10 for goods, we collect $12 from the customer. How do we do accounting for this type of transaction? Is the $10 considered a business expense?
Well, it depends on exactly what you're buying with that $10. So, for example, if you are if you're selling something for $12, let's say it's just a product, right? Let's say let's say it's a pen, right? And you're selling it for $12, and you're actually buying that pen from somebody else, or you're buying the parts for that pen from somebody else for $10. Then that $10 is a cost of goods sold. And so again, so that tells you that for every $12 pen that you're selling, you're actually making $2, right? And so you don't want to say, hey, I'm making $12 for every pen that I sell, because you're not. And so you want to track that $10 as a cost of goods sold, so that when you subtract the cost of goods sold from your revenue, you'll get a gross margin of $2, and it's that gross margin of $2 that's really the amount that's being added whenever you make an incremental sale. Now, that's one example. If you sell
Well,
if you
well, sir,
yeah.
if it helps you, he's actually asking specifically about food. Could you use food in an example? Would that be similar to the pens?
It is if you're selling food and you're purchasing that food from someone else, and you're packaging it up differently, or you're just selling directly as it was because you get better pricing, and you're selling that to someone else. Then yes, that is the same thing. If you're talking about okay, well, I'm selling a whole bunch of stuff for $12, but you know what? I buy $10 worth of food to feed myself, and it has nothing to do with what I'm selling, right? That $12 of selling, then that $10 would actually be like the person mentioned, it'd be more of a general business expense and not a cost of goods sold. So it depends on whether the cost that you're expending is directly related to the thing that you're selling that you're receiving revenue for. I hope that answered the question.
I believe it did because he's saying thank you. The
Okay,
other
good.
question we had was earlier on in the presentation. You had mentioned all the accounting tools such as Bill.com. Could you list those off one more time?
Yeah, absolutely, and that's a good question. I do know that I go through them very, very quickly, and I think Gina mentioned that she's going to be sending you. First of all, she's going to be sending you a link to this presentation, so
Yes.
you'll be able to go back to it at any point in time. But absolutely, so let's talk just a couple of minutes about the systems that I think that most startups would benefit from using. So on the accounting software, I'd say the two big ones are QuickBooks Online and Xero. Xero is a relatively new one. There's a lot of money going into it, a lot of development. It starts with an X, so it's Xero. And both of these are online, pay-as-you-go basis, supported by, oh, I'm sorry, hosted by another company, and so you don't need anything other than a browser to access them. The one benefit that I will give you, and the pricing is about the same. The one benefit that I will give you for QuickBooks as opposed to Xero is QuickBooks is kind of the main and software that everyone has used. So, whenever you talk with any accounting professional, any, bookkeeper, anyone who's done any amount of work, I can almost guarantee you that they already are experienced and know QuickBooks. Xero is the new kid on the block, and so, it may be a little bit more difficult to find people with expertise. On the invoice management side, I think Bill.com is the tool that we use. It allows you to manage the invoices coming in and the invoices going out. So the invoices you send out to clients as well as bills that are coming in, and it gives you the opportunity to go and make rules on, you just get to go online. They send you emails that says, hey, Mr. Client, you have the following bills that you should review online and approve. And you just go in and you literally check, I approve. And when you do that, then it basically sets off the systems in the back to account for it and to make the payments on the dates that they're due. Directly from the bank if you set it up that way, or you could have the checks cut, whatever you prefer. So again, very, very personalized to the way that you like to do business. The expense management piece, where people are submitting expense reports, to the company, so employees or yourself or whatever. In the past, people have done it through, setting up Excel spreadsheets and entering that data and then making copies of the receipts and putting together this big, bundle of paperwork that then someone would have to go through, the accounting professional would have to sift through and match up the receipts and all that. And now you can use tools like Expensify and Concur. And those are online tools again where basically things get automatically entered into right buckets. You could take email receipts, you could take photos of your receipts and attach them digitally to the expense report, so that when it gets submitted, then you get, by an employee, then you get a notification that says, oh, Mr. Client or Mr. Accounting Department, so-and-so submitted an expense report, please go in and review and approve. And you just, again, go down the list. You could see the expenses. You could see where they've been where they've been logged. You can match up the expense reports, the receipts against them, makes it, and all you have to do is hit yes, and then all of a sudden, then it's been entered into QuickBooks, ready to be paid. So, again, these are very, very inexpensive tools that will allow you to be much more efficient with your time, as well as your employees' time.
And sir,
I hope that answered the question.
No, it definitely.
I realize that we've already gone over.
No worries. Just kind of to spin off on that question quickly, it did answer it, but the gentleman would like to know, his company is currently based in Israel. Would these software companies work for companies based abroad, or are they specifically for the American system?
I believe QuickBooks Online is international. I wouldn't be able to promise that it works. Try it. Just go on to just do a search on QuickBooks, and look. And same thing with Bill.com and Expensify. You'll quickly turn. I don't think there's anything in Expensify that would keep us from using it internationally, nor Bill.com, but I'm not 100% sure.
Perfect. Thank you so much. And he said yes, that was extremely helpful. So thank you to Cirque, and thank you so much to all of you for joining us for today's free webinar. We really appreciate you taking the time and hope that you found this useful. If you have any follow-up questions, please feel free to email Cirque or tweet to @earlygrowth, #startupaccounting, as well as #techaccounting. In addition, please feel free to check out our events page to view and register for any of our upcoming free webinars. Thank you again, Cirque, for an amazing presentation. Thank you to all of you for joining, and we hope that you have a wonderful Thanksgiving.
Thank you, everyone. We appreciate it.
Thank you. Have a great day. Thanks, Cirque.
Bye-bye.